Home prices across the country fell for the third straight month in May as Americans are grappling with concerns over their jobs. And to that end, the government reported today that hiring tumbled last month, the hiring rate equaling last June for the lowest since 2020. It's basically the same as September 2008. And in fact, the one explains the other. There are no home buyers out there because Americans are sitting home worried over their jobs and incomes. And that's just the beginning. While consumer confidence did inch higher here in July, at least in the Conference Board survey, it was a minimal increase, especially in light of the previous plunge. And more importantly, consumers' assessments of job availability fell to their lowest level since March of 2021, further validating the alarming hiring rate that's shown here in JOLTS. And given all that, it isn't surprising to learn credit card delinquencies are growing fast. And the category seeing the fastest rise in missing payments is the higher income segment, which of course offers even more strong corroboration to falling home prices, consumer worries, all of it tied to the labor market, which is showing more and stronger signs of actually cracking. All of which sets up an interesting FOMC meeting today and tomorrow. On the one side, Jay Powell, the economy and labor market are solid. Inflation is the country's greatest risk. And on the other, the voice of reason, Christopher Waller, saying there is zero evidence for inflation. It's a bad theory to begin with. And all the evidence points to weakening in a downside case for employment. So while everybody's going to be watching the Federal Reserve, and we'll do the same thing, I'm actually going to do a live stream tomorrow, the more important stuff is all of this evidence lines up with the marketplace that says whether or not the Fed cuts tomorrow or not is beside the point. Markets say interest rates are going down, and all the data that we got here today shows why that will be. But we have to start with housing. The latest data coming out on home prices from a couple of different sources, beginning with the Federal Housing Finance Agency, or FHFA, which showed a 0.17% decrease in home prices for the month of May, which followed a 0.34% decrease in home prices back in April. And before then, home prices were largely flat in February and March. So according to the FHFA, home prices across the country are down 0.4% for this pretty contentious 4-month period that we keep coming back to as an inflection point or potential inflection point all over the economy. And that weakness was not just reflected in the Case-Shiller, S&P Case-Shiller index, but also the Case-Shiller took it a step farther. According to their 20-city average, home prices fell in those 20 cities on average 0.3% in the month of May after falling by the same amount back in April. And it had been negative in March at 0.2% and barely positive at 0.2% in February. So the year-over-year rate for the Case-Shiller 20-city average is just 2.7%. And just to give you a sense of scale here, back in March of 2024, it was still rising at a 7.5% yearly rate, and it was 6.5% last June in 2024. And it's even more negative when you get to the national figures from S&P Case-Shiller. For the National Home Price Index, housing prices fell by 0.3% in May after falling a revised 0.4% in April, and it had been down 0.3% back in March, and very minimal gain in February. So the year-over-year rate is 2.2%, but that misses the downside acceleration or the decline in prices more recently. For the 3-month period in question here up to May, prices are down almost a full percent. And year-to-date, because of the decline over these 3 months, year-to-date, the Case-Shiller national average is down 0.3%. That's how serious this imbalance in the housing market is. And while most economists like to talk about, and the financial media likes to talk about high mortgage rates and affordability crisis, what they're really saying is if there is an affordability crisis, and it's a legitimate thing, it's because of lack of incomes. Incomes never caught up with home prices plus interest rates. Therefore, as incomes become even more questionable, there are even fewer buyers out there who are able to make a home purchase. At the same time, the inventory of for-sale homes has risen, which is its own thing too. We should consider why that might be, which means that the imbalance in the housing market is shifting in the wrong direction for macroeconomic reasons, not the Federal Reserve and interest rates. I almost never do ads, and I say no to the vast majority of those that are brought to my attention, but I was thrilled to be able to work with today's video sponsor, Monetary Metals. And the reason is because they're solving a big problem, one that I've been highlighting for a very long period of time. Gold is a safe haven, but other than sitting in a vault, it doesn't do anything. Monetary Metals fixes that. They let you earn real yield paid in physical gold without giving up ownership. It's not a fund, it's not a paper claim, it's your gold working for you. Every month, more gold gets deposited into your account. It's simple, it's transparent, and it is fully insured. If you believe in gold as a long-term store of value as I do, this changes everything. Go to monetary-metals.com/Snyder. That's monetary-metals.com/Snyder for all the details. We absolutely thank them for being the sponsor of today's video. And now let's get back to it. And I already talked last week about existing home sales according to the National Association of Realtors. That dropped below 4 million seasonally adjusted annual rate in June, which was well below expectations of just above 4 million. But really just scraping along the bottom of a range that's equivalent to the bust period of the last housing cycle. And even though the median sales price according to the NAR for resales was $435,000 and some change, and that was up just less than 2% from last year, like we saw in these other home price estimates, the rate is slowing down and slowing down fast here in the middle of 2025. And it's the same over there, if not worse, in terms of new home sales. New home sales is win over last week, just 627,000 seasonally adjusted annual rate for June, basically flat with May after May's sales pace plunged by nearly 12%. So June basically stayed at that low level, and you can see there's a downturn in new home sales over these same months in question here in 2025. So we're back in terms of new home sales at the 2022 lows, only this time you really can't blame mortgage rates. Mortgage rates, as I pointed out, haven't really changed all that much over the last several years. If anything, they're slightly lower. And in a healthy economy, 2 years would be long and more than enough for consumers and buyers and workers to have adjusted and normalized to this level of mortgage rates. The fact that the home market and real estate market overall continues to slump to the point that we now see falling prices suggests not interest rates, something has changed in the macro economy. Of course, we know what that is. Even Bloomberg is starting to know what that is too. Here's the article pointing out spring is traditionally the busiest season in real estate, not unlike Christmas for retailers. And while the most unaffordable housing market in decades has sidelined all but the most determined buyers, there were signs earlier this year, the artificial high, that conditions were right for a rebound. Now, it's arguable whether or not that was really the case. I mean, they're mostly talking about a potential for a decline in interest rates, but the affordability problem always goes back to lack of incomes, which, shockingly, the Bloomberg article starts to get into. Continuing. By April, mortgage rates dipped, price growth flattened, and the years-long inventory drought looked like it had finally broken. Fewer sales contracts were signed in the U.S. from April through June, however, than in any year since 2012, according to data from Redfin. That was back when the housing market was still finding its footing after the collapse, which fueled the financial crisis. And that's not really true, but that's what everybody believes. Before 2025, the previous two springs were also weak, more for interest rates, pulled down by high rates and prices. But anxiety over the future of the economy has made things worse this time, said Chen Zhou, who's head of economics research at this brokerage house. So while they still want to make it about high interest rates, they're starting to get the sense that something is different here. And what's different is not interest rates. As I said, in a healthy economy, everyone would have normalized the interest rates where they are, and they're still not historically high to begin with. But instead, we see something has changed, and it's changed mostly on the buyer side of real estate, which means concerns over jobs and incomes. This is small e economics, and it's pretty simple small e economics. And that's where the latest labor data comes in from the Bureau of Labor Statistics. The same people put together the payroll report in the form of JOLTS, job openings and labor turnover. And while job openings, that's the one everybody's going to talk about in the mainstream, even though it's the least reliable stat, maybe the entire universe of U.S. macroeconomic accounts, and it declined here in the month of June. That's the latest figures that they're presenting for us today. JOLTS job openings massively overstates the demand for labor, not being able to account for double postings and dummy listings, or for how PR departments all over the economy will post jobs just to look busy and keep their roster of resumes fresh, just in case, maybe the company might actually hire someone in the next 10 years. But because JOLTS wildly exaggerates job openings, when it does fall like you see in June, getting back down to the same low range, you're pretty confident there was some significant weakness, even if we don't really know by how much. Even the mainstream is starting to understand the distinction here. According to this article, some economists have questioned the validity of the JOLTS data. It's not economists, it's just common sense, in part due to the survey's low response rate and heavy revisions. A similar index by job posting site Indeed, which is reported on a daily basis, showed openings tick down in June, extending a steady downward streak throughout this year. And already that's consistent with what we see in the housing market, as well as spending and other figures from across the macroeconomic landscape. But it keeps going. In fact, it gets even worse when we get into the real data point that we want to focus on where it comes to JOLTS, and that's hiring. The number of hires, and especially the hiring rate, those are vastly more important than job openings. And according to the BLS, there was an artificial boost to hiring a couple months ago, related to the tariff front loading that led to a bump in hires by April. But from that 5.6 million number, hires have been slowing down here on the other side to just 5.47 million in May. And then the latest figures that we got today slumped all the way to just 5.2 million for June. How bad is that? It is barely more than last August and only 120,000 above the shocking number from the previous June, which started the market slide into the chaotic carry trade reversal by the end of July and into early August. It's the same one which led the Fed to cut by 50 basis points last September. So here we have June 2025 and this critical measure of hiring right down in that same low territory. And when you convert it into a hiring rate, which you should always do, and that's just the hires as percentage of the population, here the civilian non-institutional population, the hiring rate for June 2025 is the same as that shocking low in June of 2024. And how bad is this 1.9% hiring rate? Along with last June, it's the lowest since April of 2020. In fact, you have to go all the way back to February 2014, which was still in the aftermath of the Great Not Recession, for something that low in the Silent Depression 2010s. And the lack of hiring down at this rate is exactly why the 2008 crisis turned into the Great Not Recession in the first place and made it into the Silent Depression. 1.9%, that's September and October 2008 rates. It's less than the entire dot-com recession. That's how little hiring there is. And that would be perfectly consistent with this low level of hiring and all the other macroeconomic concerns with what we're seeing in the housing market and everything else beside. It gets us into a path where you can see interest rates going lower and staying there. And since nobody is hiring, we got hiring rates that are down this low, quitting also tumbled, as you would expect. The rate, according to JOLTS, was down to 3.14 million in June, and that's less than the 3.27 million in May, to the lowest since December. So these voluntary separations have been in a low range themselves, especially when seen from the quits rate, which is in proportion to the population, or in this case, in proportion to the amount of jobs. American workers will quit the job that they have more often because no one likes the job that they have, and they'll go looking for a job they really want when there are jobs people really want available, which is unlike now. So with few good job opportunities, workers are understandably staying put. You see, look at all the statistics here, and as far as the FOMC debate or argument is concerned, Christopher Waller has all the evidence. Meanwhile, Jay Powell's got nothing but bad, disproven theories. So it makes tomorrow's FOMC meeting interesting, at least in that respect. And so that's why I'm going to do a live stream tomorrow at 1:30 p.m. Eastern Time to go over all the relevant details about the FOMC meeting, to see what it is the FOMC might be seeing here and whether or not one side or the other might actually get the upper hand. Does Waller have enough to convince all of the inflation-biased hawks on the committee that Jay Powell is doing things for his own reasons, and he's often in some other world that has nothing to do with the macroeconomy that we actually see here today? So follow me again tomorrow at 1:30 p.m. Eastern Time. We'll talk about what's happening with the FOMC. Will they actually cut rates? I still think there's a chance that it does happen. So you've got home prices that are falling, transaction volumes in real estate, sales, new home sales, existing home sales they're in the dumps. Jobs, nobody's hiring, nobody's quitting. There's no employment opportunities out there. Income concerns proliferate. So of course, in that background, credit card delinquencies are going to be rising, and not just for the poor Americans, those with lower incomes, but also, as this article points out, for those on the other end of the spectrum. Upper income Americans are increasingly falling behind on credit card and auto loan payments, signaling an underlying vulnerability in the U.S. economy. As they're actually saying this, the labor market slows. Delinquencies on such debts from those making at least $150,000 annually have jumped almost 20% over the last 2 years, faster than for middle and lower income borrowers, according to credit scoring firm VantageScore. In addition, a recent Federal Reserve Bank of St. Louis study found the share of people making late card payments in the highest income zip codes has risen twice as much over the last year as in the lowest income ones. The mounting liabilities coincide with a slowdown in hiring that has hit white-collar workers especially hard, raising the stakes for an economy that has come to rely more and more on consumer spending from top earners to power continued expansion. And so there we're starting to put together all the pieces that fit with this macroeconomic puzzle that then leads to lower interest rates, a lot lower interest rates in the future. In this case, you've got the housing market, lack of jobs, lack of incomes, and the sudden turn in consumer spending that we've been talking about in terms of retail sales, even though retail sales were higher in June, but also personal consumption expenditures that have done something that we rarely see, which is be negative on a 5-month basis. Higher end consumers are grappling with the same macroeconomics, and those depression-like macroeconomics have finally gotten to be too negative that it's even impacting higher income Americans. Thus, overall spending is starting to buckle as well. So one final note from the Conference Board, its Consumer Confidence Index did move higher, it inched higher to use the Conference Board's terms, here in July. But, as it points out, consumers' assessment of the present situation was little changed. They were a tad more positive about current business conditions in July than June. However, their appraisal of current job availability weakened for the 7th consecutive month, reaching its lowest level since March of 2021. Notably, 18.9% of consumers indicated that jobs were hard to get in July, up from 14.5% back in January, as if something big has changed over the months in between. And they also point out the expectations index, based on consumers' short-term outlook for income, business, and labor conditions, rose 4.5 points to 74.4, but that expectations index remained below the threshold of 80 that typically signals a recession ahead, and doing so for the 6th consecutive month. So while consumer confidence in these various measures are off their recent lows, they're not off those lows by all that much. And it fits within the overall picture of something big has changed in the economy, not just in April related to tariffs or the stock market collapse, more macroeconomic factors that are lingering on into the middle of this year and pointing toward exactly where the markets have all this time. Conditions in the real economy that are going to lead to interest rates going down. So we've got home prices falling for 3 straight months. We got more inventory in housing, less sales because of fewer buyers. We don't like it, but the economics, small e economics, makes perfect sense. Why are buyers sitting out? Not interest rates. It's about jobs this time, and Americans are not seeing them. As a result, unemployment is piling up, as are, understandably, fears over worsening conditions. Credit card delinquencies just goes along with all of that. And consumer confidence, while it's inching higher, the fact that it isn't soaring like stocks is a huge warning, especially given the reason for the ongoing pessimism. Americans know there are no jobs. Well, most people want to know if that means the Fed's going to cut rates tomorrow. The truth is, the FOMC doesn't matter. Whether or not they cut in July is immaterial. The markets have been saying that interest rates are going to go down, and all of the macroeconomic data that we continue to get, including what we got today, is consistent with this low rate, no job, no inflation future. Another one of those factors, oil and oil prices. Everyone in the energy space is bracing for an oil supply glut later on this year. Why? Same reasons as everything went over, and I went over the details in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers, and until next time, take care.